Hi everybody, good afternoon. Please give me a moment as I go live on Facebook. This is Sami Abu Saad. Be with you shortly. Okay, I think we're live on Facebook. Hi everybody, good afternoon. Hope you've been well. This is Sami Abu Saad with T3 Live. We are resuming our lesson series. It took a 2-week break because last week I was out sick. Week before that I was in New York City doing running the mentorship program, so wasn't available. And yesterday my voice was too weak, was coughing too much to do the lesson. Usually I do this on Tuesday afternoon, as you know. But here we are. We're gonna pick up the thread where we left off and cover lesson number 30 today. Before I start, just want to say, please be sure to check the links in the description below if you want to find out how you can trade with me for the next 30 days or so. Also, be sure to hit the like button if you find benefit in today's video. And last but not least, just a standard required disclaimer to let you know that trading is risky and that whatever we discuss is for educational purposes only. With that out of the way, let's go ahead and get started. So we've been covering these amplifiers, things that make the setup even better, right? We covered all these, there's 10 of them, but we covered 8. The bottoming, topping tail, changing the guard, the narrow range bar or narrow body, above average volume, minor support, resistance, the retracement zone of 40 to 60%, moving averages, mainly the 20 MA. And a couple weeks ago, in the last lesson, we covered major support, major resistance. Now, I hear from a lot of people via email, and I just want to make sure that we know we have context, okay? That we know that these amplifiers apply when we have a setup, and in particular, the buy setup, okay? What's a buy setup? Well, just always remember that stocks can really only correct through two ways. One is by basing, so that's through time, by going sideways, or through price by pulling back. So again, stocks can correct through time by going sideways, or through price by pulling back. Now the buy setup is basically a pullback, and there are 2 types of buy setups. There are 3 types, but for purposes of this discussion, let's just say there are 2 types. One is the pullback in an uptrend. So you have a stock that's in an uptrend and pulls back. Now there are certain criteria for the pullback. Not just any pullback is acceptable. We've covered a lot of information about the buy setup in particular that's in an uptrend, because that's the most common. So there's the uptrend and then the pullback. You gotta have 3 or more consecutive lower highs or 3 or more red bars. That's the key criteria. The optional would be 3 or more lower lows. We're talking about lower bars, right? The bars that have lower lows. And then, you know, if the stock starts to turn back up, then you buy it above the 1 or 2 cents above the last red bar's high, stop under the pivot, target the prior highs. After 2 bars in your favor, you can start going bar by bar. Okay? That's the management. So that's basically the buy setup. Now, if we were to look at a real chart, that's what it looks like. You have a stock that's in an uptrend. As you can see, stocks don't go in an uptrend in a straight line. It's like, you know, they go in an uptrend in a wave, almost. Up, down. They're constantly correcting. They correct because people take profit. People take profit. As they take profit, the stock comes in. and then it moves up. It's in an uptrend, it's being bought, and then as it starts to come in, people start taking profits. As it comes in more people get out of it, and so it ends up pulling back, right? Now, can we capture the next wave up? That's what we're trying to do with this buy setup, and that's what it looks like. Here's a buy setup that actually, I'm showing you how it played out. And beautiful, right? Notice we don't have 3 bars. We had 1, 2, 3, 4, 5, 6, 7 or 8 red bars in a row. That's fine, as long as it doesn't violate the uptrend. It doesn't have to be 3 bars. It can be more than 3 bars, as long as it doesn't violate the uptrend. This was also a transition buy setup. We've talked about the transitions, how stocks transition from stages 1 to 2, from 2 to 3, from 3 to 4. So this was a transition from stage 1 to stage 2. And notice the pullback to the rising 20 and off to the races. Here's a stock that was in an all-out uptrend, and again, giving us beautiful buy setups. Not every stock, not every chart is going to look like this, for sure. But look, one of the key advantages that we have in this business, in this job, is that you don't have to trade when the odds are not clearly in your favor. You don't have to pull the trigger. So you can actually wait until the odds are so overwhelmingly in your favor that you can't help but take the trade. Does that make sense? So that's the way to do it. When it's a good environment, then you want to be aggressive. When things are following through and things are just in general working, you want to be aggressive. When things are a little bit slow, not working, that's when you have to be very, very picky. Okay? Now, the sell setup, the T3 sell setup, is the same, the mirror image of the buy setup, but for stocks that are in a downtrend. So you have a stock that's in a downtrend, rallies, corrects through price by rallying, right? As people cover, right? Stock rallies, and gives you at least 3 or more green bars, or at least 3 or more higher lows, right? We want higher lows in this case, not higher highs. Higher highs is nice to have, but it is optional, not required. If we get that, then we have what's known as a sell setup. And then same thing, short under the last green bar's low, stop above the high, and then target the prior pivot low. After 2 bars in your favor, you can go bar by bar. Sometimes you can get a lot more than your target as the stock continues lower. This is an example of a real chart, real sell setup, right? So we talked about, so far, just giving you a review of the buy setup, the uptrending buy setup, the downtrending sell setup. But what about the second way, which we talked about 2 weeks ago in the last lesson? What about the buy setup that's in a sideways trend? For that, the same amplifiers apply. For the most part, they apply. But you gotta have 2 equal lows before you can start buying. That's what constitutes a base, is you have to have 2 equal lows before you start buying it. You have to have 2 equal highs before you start shorting it. But it's the same thing. It's you gotta have 3 or more red bars, same exact thing. To a double bottom, you have to have 2 lows. There are exceptions. Sometimes 1 prior low is enough. If the prior pivot low was a climactic buy setup, or if there was some kind of a failure there, or if this new pivot also happens to be at, happens to be solidified by, let's say, flat 200 MA or rising 20 or something else additional. But usually we need 2 prior lows before we can actually buy at major support and call it a buy setup in a sideways trend. A lot of the times, as we all know, markets spend a significant amount of time in sideways bases. So it's a good idea to learn to play the bases. Okay. Same when we're looking at shorting the top of the base, you gotta have a double top first. Then you can play it. Does that make sense? And that's called major resistance. We talked about major support and major resistance last week. We said major support exists exists due to a self-fulfilling prophecy. People that bought got rewarded. Rewarded traders always look to repeat their action. So major support exists mainly due to positive memory or self-fulfilling prophecy, because rewarded traders look to repeat their action on the next go around. Not only that, but traders sitting on the sidelines that saw the nice big move look to also get rewarded too. Likewise, the ones that bought at the top and got hurt, they look to exit when the stock retests their entry point. So major resistance is created in large part due to negative memory. Okay, it's an area of pain, and when that area is revisited, traders who held on to their positions look to exit, which starts the sell-off, right? But not only that, you have the shorts that see what happened, that see that the stock dropped a good amount, and they look to take advantage by shorting the next time the stock revisits that area. So the area here, I guess I should say the group of sellers at this area becomes a lot more than just the buyers that were trapped, that were looking to redeem themselves. It's all the professional traders, the day traders that look to short in that area, which creates major resistance. Now, here's a real chart showing you major support, major resistance. As I said, the first couple of tops, you want to actually let go. You don't want to touch. But if the stock double tops, in this case it triple topped, then you can do every other sell setup. Okay, likewise, first couple of bottoms you don't want to do, but then the third time, the charm. The third time is when you start playing the bottom. Okay, eventually all sideways trends break, and there are clues. If you pay attention, you can actually you can figure out when the stock is ready to go. For example, in this case, notice how it was the first time it had been basing for how many months? I mean, 3 months maybe. It was the first time that this bar, that first the stock didn't even make it to the bottom of the base, and in one bar it retraced up to the top. In one bar, to 80% to the top on healthy volume, but the volume is not everything. We had even a bigger volume bar right here, but in this case it got right to the top with just one bar. Here it took 3-4 green bars in a row. Same here, likewise here, same here. This was the first time that in one bar we negated 80% of the move down, and it happened on a higher low and on good volume. So that was kind of a clue that the next sell setup here should have been avoided. Now the truth is there was no sell setup, so it's not like it triggered short. It didn't even trigger short before breaking out. Okay, so this is a good chart, a good example of a sideways base. They don't always come this clean, but if it's a sideways base, if you have a double top, you should not look to take a breakout. You should not. On the next time it goes higher, you should not look to take a breakout. You should actually look to short the next time the stock goes up there. In the same way here, this play here, you see how it broke down? That's bad. Never short the break of support after multiple bars down to the break of support. Never short. So again, after a double bottom, you want to go long, not short. So just keep that in mind. It'll keep you from making mistakes. So in today's lesson, or just kind of a review and recap, we talked about the main pattern in which stocks correct, or one of the 3 main patterns, which is the pullback. We said that stocks can, if they're in an uptrend, you have the T3 buy setup. That's the uptrending buy setup. If the stock is in a sideways base, then you can buy the bottom, right? But the same amplifiers apply. Some of them don't, like the retracement percentage when we're in a sideways base doesn't really apply, but everything else does apply, right? So what are these amplifiers? Can we actually do a quick recap of what these are? Sure, let's do it. We'll do maybe the top 4 today, and then next time we'll do the bottom 4. Okay, this way everybody maybe hopefully catches up, and we're back on the same, all on the same page. Okay, before continuing, so what's a bottoming tail? Again, and a topping tail. Again, we're interested in bottoming tails only if they happen on a buy setup, only if they happen after 3 or more red bars in a row. And a bottoming tail has to be a bar that at least 50% of the bar needs to be made up in tail. So the tail needs to make up at least 50% of the bar's size, and it needs to happen. The bottoming tail bars that we're interested in are the ones that form after 3 or more red bars in a row. If the stock is in an uptrend, hopefully at the right location also, such as the rising 20, the 40-60% retracement zone, the minor support. Likewise, if we're looking short, if we get a topping tail, that makes the setup even better. Got it? It makes the setup more potent, and that's why we give that pattern 10 extra points. 10 extra points. This is a bottoming tail. Notice we had 3 red bars, and the bottoming tail itself was the 3rd bar. That's okay too, as long as we have 3 red bars or 3 lower highs. In this case, we had 3 red bars, the last bar being a bottoming tail. That's okay. Now, it wasn't really in the right location, so here's a better one. That's a better location at the rising 20. And notice the bottoming tail. The buy setup triggered through a gap, which makes it even more powerful when the buy setup is ignited through a gap. Again, we are not looking for just any kind of a tail. We're looking for a bar that has the tail makes up 50% of the size. So for example, this bar doesn't qualify as a bottoming tail. These bars do qualify as bottoming tails, right? The ones that are marked. The one that we like is the one that comes on a setup, such as this one. Okay, that's a bottoming tail. Now when we're looking to short, the same thing. That's a topping tail, right at the declining 20. So that actually gave us a sell setup, which gives the sell setup 10 extra points. Okay. Now, topping tails, bottoming tails are signs that major institutional buying or selling has taken place, especially if the topping tail or bottoming tail happens on large volume, significant volume, and the bigger the better, right? If it's a really big bar. Because tails, the way they form is, topping tails initially was a big green bar. But before that bar had finished forming, the seller showed up and forced prices lower to close in the at least below the 50% mark. Okay? At least below the 50% mark. If it closes right at the bottom like it did here, right here, this tail right here, so much the better. So that's how tails form. So before the bar finishes forming, that green, that buying gets rejected. And so everybody that bought it on the way up here, it gets trapped, so to speak, because people don't buy it expecting to immediately sell it right away. They're thinking of holding it, and so when it gets slammed like this, they get stuck in it. So, and then the fact that all that buying got reversed, again, that's a sign that major institutional selling just took place, and that's why we like tails. They trap people. Right, they increase the supply, and it's a sign that institutional selling took place. The same, of course, applies to bottoming tails. This was a bottoming tail at major support. Even though there was only one pivot, this qualified as major support because it started from a professional gap up, a mortgage gap actually. Okay, all right, good. So just a review of the first amplifier. The second amplifier is usually the most confusing for people, so just pay attention to this. It's called the changing the guard. Okay, our second trading combination is the name we've given to a multi-bar pattern that signifies a clear shift in power, and the balance of power has just occurred. There are 2 types: bullish, right, and bearish. Now, before we show the potency of the price pattern when it's combined with the T3 buy and sell setups, it's necessary for us to explain the powerful reasoning behind it. You might remember the slides from earlier. We said that each time a stock closes above its opening price, the buyers are considered to have won that particular bar or battle. Okay? Each time a stock closes below where it opened, the sellers are regarded as the winners of that bar. So the following formulas will demonstrate. The formula is, if the stock closes, here it is, if the close is above the open, the buyers are the winners of that battle, of that bar. Okay? It's all about supply and demand. Trading is all about figuring out whether a stock has more supply than demand or vice versa. And so if a stock closes above the open, it must mean that the buyers overwhelmed the sellers. There was more buying than selling, basically, right? And vice versa if the close is below the open. So imagine if you get the buy setup, the 3 or more bar pullback, to either a double bottom or in an uptrend to the rising 20, minor support. Does that make sense? So imagine if you get that buy setup, and on top of it, you get the COG bar, that green reversal bar, without even having to risk your money. Do you understand what I'm saying? What I'm saying is the COG bar is the green bar that forms after 3 or more red bars without triggering the setup. It's not an entry bar. COG bar, here, we say it here actually. The COG bar is not an entry bar. So it gives you, it's a warning bar before the setup triggers. So check it out. What's nice about this bar, one more time, is that we already see that the buyers took back the control, but without even risking any money. Usually, you have to risk your money to get into the play before you can even, before the bar finishes, before the green bar even finishes forming, right? Before it finishes forming. In this case, because it did not take out the prior bar's high, you didn't even have to risk a dime. So what's nice about the changing of the guard bar is that we get proof that the buyers took back the control, or if it's a bearish COG, that the sellers took back the control before we even get into the play. It's because the COG bars are not entry bars. They are the warning bars before the setup actually triggers. So this is what it looks like. You get the pullback, a COG bar, plus in this case a bottoming tail bar. So this setup in particular, so it gets 20 points, the buy setup, and then 10 points for the bottoming tail, and 10 points for the COG. So that's a 40-point play. That's a 40-point play. Does that make sense? So that's the COG bar. Here's a real chart with a COG bar. You see it? That green bar without taking out the red bar's high. That's a COG bar. That's called the COG bar. This is a particularly nice chart because we had a transition here. As you can see, the stock transitioned. And yeah, some of you might say, oh, it's cup and handle. Yeah, it is. But it doesn't matter. What matters is reading the chart. You don't need to know the names. And so the stock transitioned here. So that's what's nice about it. Gave us a nice, big, healthy COG bar. And then from there, it doubled. More than doubled. So that's a weekly time frame. Okay, so that's a COG bar. Any questions about it? That's a COG bar. Are there any questions about it? See, it's a green reversal bar. It's a warning sign that that the stock is getting ready to go back up before you even risk your money. So that's a COG bar. Okay, got it? It's beautiful. It's absolutely beautiful. One of my favorite setups is when we have the buy setup with a COG bar, an inside bar. Okay, so that was the second amplifier. The third amplifier is the narrow range or narrow body bar. So basically, if we get a buy setup with followed by a narrow range or a narrow body. Narrow body means the range of the bar from high to low, from here to here, is normal range, but the size of the bar, the body of the bar, is very narrow. So if we get a narrow range the first two are considered narrow range. The last two are considered narrow body. If we get a narrow range or a narrow body bar after 3 or more red bars, that setup gets 10 extra points. It's an amplifier. It makes the setup even better. Now, why does this get 20 points? Notice how these are the first and the fourth get 10 extra points each. Why? Because they are also COG bars. Does that make sense? They are changing the guard bars. And the same, you follow the same thing. Buy above the COG bar, in this case also a narrow range bar, stop below it, target the prior high. After 2 bars in your favor, you start going bar by bar. Okay. What's particularly nice about the narrow range bar is that, so I'm talking about the first two. What's really nice about them is the fact that you get a tight stop. Stop is under the lows and your target is up there, let's say. Well, that's 4-to-1. 4-to-1 reward to risk. So it gives you a tight stop, and if you have a tight stop, you can have a lot of shares, right? Because the stop, the share size depends on the size of the stop. The tighter the stop, the more shares you can have. So that's what's nice about it, is the fact that you get a tight stop. But not only that, there's another thing about it that's good, and that is that most stocks don't really mount a real reversal without first putting in some sort of a narrow range bar or narrow body bar. They don't put in a real reversal without. So the narrow range bar is your sign that the stock is ready to reverse. Think of it like a car that's driving on the road, and if you, let's say the car in front of you is driving on the road, and if you see that, and if you see that the car is slowing down, maybe they turn on their blinkers, right? Then you can, it's not going to make a U-turn going full speed unless it actually slows down. Does that make sense? So the same here to some extent, and in that the stock usually doesn't turn around unless it slows down. So the narrow range bar is the sign that the stock is actually slowing down before it can mount again a successful reversal. If we look at most charts, most reversals, that's a narrow range bar, by the way. If we look at most reversals, you'll see whether they're valid setups or not. You'll see that most of the time, before the stock turns around, it'll slow down first. It'll print narrow range bars, almost always. So there are some exceptions, of course, but look, all of these are narrow range bars. There's a narrow range bar. Does that make sense? All of these. So stocks usually don't turn around up or down unless you get the narrow range bars. Here's another chart. You can look at any chart you want. Usually, when the stock is ready to turn around, it always has to slow down a little bit. Usually, not always. Usually, like for example, right here, when the stock goes a little climactic, it doesn't have to slow down. If it accelerates, then it can just turn around quickly, which is what happened here, right? Look at the volume also. But unless it's a climactic setup, and even if it is a climactic setup, most of the time we get a narrow range bar. So it's a great heads up for us as traders, because we're constantly stocking plays. So as long as you don't see narrow range bars, don't get too excited. The moment you see the narrow range bars, that's when you start to think, that's when you should start to think that, we're about to turn, I better get ready. Does that make sense? So that's what the narrow range bar, narrow body is. Now, with regards to the narrow body bars, because of the tails, they're actually more indicative of a real battle. So when you have tails, the tail, you have to always remember how tails form. In this case, the stock actually initially, so opened here at the bottom, rallied, then sellers showed up, forced prices lower, and before that bar had finished forming, the buyers stepped up and pushed prices higher. So when you have a narrow body rather than a narrow range, it signifies that there is a real battle. So as soon as the stock takes out the prior bar's high, then you know who's winning the battle. In this case, the buyers would be winning the battle, right? Does that make sense? So that's what I like about the narrow body bars, is it actually signifies a battle is happening, and the moment we take out the prior bar's high, then I know the buyers are winning, and I better bet on the buyers. I better jump in. With the narrow range bars, it signifies that the stock is slowing. There's a slowing in momentum, and it perhaps is about to turn the corner. But it doesn't necessarily show us that there was also a battle. When you have a battle, it's basically the buyers and the sellers are testing each other, right? They're fighting. So in this case, if you're bullish on the stock, right, and you get the battle here, as soon as the battle is won, that's when you want to commit to the stock, because now the buyers have showed you their teeth. Now you know who's winning, who's stronger. So I like narrow body bars more than narrow range bars. The only issue is with narrow range bars, we get a tighter stop. So the reward to risk is increased compared to the narrow body bars. That's it. But otherwise, narrow range bars are better than narrow body bars are better than narrow range bars. Okay? So hopefully that makes sense. I hope that makes sense. These are setups. Look at over here. Narrow range bars. Almost always when there is a turn, there's always narrow range bars. Almost always, not always. Okay? More of the same here, right? More of the same. And with a buy setup, with a narrow range bar, narrow body bar, almost a near perfect buy opportunity. Okay? Almost a near perfect buy opportunity. All right? So of these four, which one do I really like the most? If I was sure about the setup, if I was sure about this setup is going to work, and I don't need to get a lot of, didn't need to get a lot of amplifiers, then I would say the smaller the bar, the better, because then I can have a lot of shares. If I was sure about the setup to begin with. If this buy setup was a little shaky, then this bar would be my favorite, because then the breach of the high would be a strong indication that the stock is higher. And since it's a little shaky, I want all confirmation possible. Does that make sense? Otherwise, the smallest bar, like this green bar, if it's the smallest, then that would be what I would want to go with. So if the goal was to maximize the reward to risk, then the smaller the better. If the goal is to get as much confirmation as possible, then the bar with the tails and the narrow body is best. Okay? The end product is a near perfect buy opportunity. All right? Okay, so far we've covered 3. We'll cover one more and call it a day for right now. Okay, for today. The fourth amplifier is above average volume. The rule is if you get 3 or more bars in a row, up or down, above, and you get a spike in volume, above average volume, after strong up or down move, indicates that a near-term price reversal is at hand. Does that make sense? And there are 3 types of volume. We talked about this in a previous lesson. We said novice, which typically ends the current move, pro, which ignites a brand new move, and continuation, which only forms inside of bases, which leads to the continuation of the most recent move. The most important of the 3, by far, is the novice volume, because it comes before the reversal. Pro comes after, and continuation is great to have, but it's rare to find, so it's not very common. And that's why novice is the most useful by far. So again, if you get a buy setup with a spike in volume, that gets 10 extra points. What does a sell setup with a spike in volume gets 10 extra points? In this case, this bar was also The little green bar was a narrow range bar. It was also a COG bar, a changing of the guard bar. So 20 points for the buy setup, 10 points for the COG bar, 10 points because the COG bar was also a narrow range bar, and 10 points because we got this spike in volume. So this is a 50 point buy setup. Likewise, this was a 50 point sell setup. Now, what does it mean? What do we mean when we say that after multiple bars down, if you get a spike in volume like so, that it signifies that a near short-term bottom is at hand? Why is that? Why is that the case? Anybody? Feel free if you're in the room here with me in the VTF. Because a spike in volume means that the weak hands, that there's short-term exhaustion in the sellers. So if it's a strong stock, and then it starts to come in, it means that the sellers, people are starting to take profit. So when we get a spike in volume, that tells us that the sellers are exhausted now, which means it's a strong stock, right? Which means hop on board, time to get in it. Selling is over. So it signals short-term exhaustion. Okay, it signals short-term exhaustion. That's why when we're playing climactics, the stock that's down a lot, one of the best indications that it bottomed is when you get the spike in volume at the bottom, right? So if you get the spike in volume, that's your best indication that the stock actually bottomed. Today we were looking at the CHK, I think, and it didn't get a ton of volume at the bottom, but take a look. Actually, it didn't come even on the very last bar. It came a little bit before. When we're looking for climactics also, it's the same thing, whether it's a buy setup in an uptrend or a stock that's down a lot and you're looking to play it for a short-term reversal. We like it when we get the biggest bar at the bottom. I checked right now because I played this actually today. I played the CHK today. So it made 750. We like to get it's nice when we get when the last bar has the biggest volume bar. But it's not absolutely necessary. It's just that when a stock is down, we like to get down a lot. We like to see a huge spike in volume. That indicates that a near short-term bottom is at hand. Okay, so start thinking of playing it long on the next entry. Does that make sense? Likewise, if a stock is down, every day somebody in the room asks me about shorting something on a base breakdown, and I look at it, and if the stock had a spike in volume, either in the base or at the bottom of that sell-off, then I don't short the breakdown, because it means the sellers are exhausted. Even on a stock that's basing at the lows, I still don't short it. Does that make sense? So that's what it is. So if we have a buy setup, we get a spike in volume, it means profit taking or selling is over, almost over. So get ready to play long. This is called novice sell volume. It means the novice sellers are out, getting out. Now, why are they novice? Because getting out after multiple bars in a row on a strong stock is too late. That's not the right way to exit. You want to exit early, not after multiple bars down. That's novice traders getting out of the stock, panicking out of it. Likewise, if a stock is weak and rallies 4 bars in a row or 3 bars in a row and gets a spike in volume, that's called novice buy volume. Novice buyers finally covering, they were in a short covering, but covering too late. That's when the stock usually turns around and drops. Yeah. So that is an amplifier. A lot of times it's not all novice and it's not all pro. For example, on the way down here, this was novice. That's novice sell volume. On the way up, that's pro igniting volume. Does that make sense? So if you look at a weekly chart, then this was a daily chart. If you look at it, this is a daily chart. If you look at a weekly chart, you would actually get just one bar right here. The majority of it you should consider, if it comes at the end, as novice sell volume. Got it? But the truth is, if you look at the detail, you often find that there is a spike in volume indicating the bottom, and a spike in volume indicating the start of the new move. Professional traders recognize what's happening, and they look to get in after they see the spike in volume. Does that make sense? I do it. You think people on Wall Street don't know this also? Of course they do. So you get the spike in volume to signify the beginning of the new move. But it's much more useful to have the end of the move, because now when I see that, then I start stalking it. If I get a spike in volume, great, on the way up. But if I don't, no problem. I'm already stalking it. And if you wait for the volume on the way up, the pro volume, if you wait for it to form, the bar also will have formed, meaning it'll be too late to get in it. Does that make sense? So novice volume is much more valuable, much more useful than pro igniting volume. Not that pro igniting volume is bad to have, it's great to have. But again, if you wait for that volume bar to form, you end up buying the stock up here when it was already almost at target. So you have to buy it as soon as it takes out the prior bar's high. The entry for this was actually over the red bar's high, right here. So you would have been in it before the green volume bar even formed. Does that make sense? Same here, as you can see, stock was down a lot. That's a climactic buy setup. Notice the spike in volume, indicating short-term bottom. Or it could be long-term bottom. It doesn't have to be short-term bottom, but indicating that a bottom is close at hand. Down a lot, spike in volume. There was a small spike in volume here too, in this bar, and as you can see, the stock bounced a good amount. Spike in volume here, stock bounced. Does that make sense? So I definitely, when I'm looking to get the bottom, I definitely pay attention to volume. On the way up, while the stock is moving up, I don't even care about volume until I get a spike. If I'm in it, then I start to look to get out. Okay, but all right. I think that's gonna do it for today. So I hope you enjoyed today's lesson. It was more of a recap of what we've already covered in previous lessons. If you'd like to learn more about trading and participate in the trades that I call in the room on a daily basis, feel free to check out the link in the description. You can join the Strategic Day Trader if you've never been a part of it for just $49 for the next 30 days. That's just dirt cheap. Now you might say, I'm a swing trader. Then you can actually join the Strategic Swing Trader and take advantage of the swing plays that I call, the coaching that I do, as well as the earnings plays for also just $49 for the first 30 days. After that, it goes to $95 a month on a month-to-month basis. So you can actually cancel whenever you want. No commitment. So I dropped a couple of links in the description. Feel free to check them out. If you have any questions, reach out to our customer service, info@t3live.com. Thank you so much for tuning in. I hope you enjoyed today's lesson, and I'll talk to you next week. Good night, everybody.